Today, we're diving into a huge puzzle at the very heart of the global economy. On one side, you've got US stock markets just soaring, hitting all-time highs, basically flashing these incredible signs of optimism. But on the other side, well, the very foundations of the global system feel like they're shaking, with instability popping up on multiple fronts. So what on earth is going on here? All right, let's get into it.
First up, we're going to unpack that core contradiction in the market. Then, we'll explore the three massive headwinds that are fueling all this tension. We're talking geopolitical fires, a brand new tariff shock, and some serious cracks forming in our financial bedrock. And finally, we'll ask the big one, is this divide even sustainable?
So, let's set the scene. Imagine it's August 28th, 2025. You glance at the market headlines, and on the surface, everything in the US looks, pretty calm, maybe even rosy. But that calm is just a thin veneer, and it's hiding some really powerful, conflicting currents churning right underneath.
I mean, the story being told by the big US stock indexes is one of pure optimism. You've got the S&P 500, that's the broadest measure of the market, closing at a new record high. That's the kind of headline that just screams confidence and economic strength.
And if you look a little closer, you can see it right here. The SPDR S&P 500 ETF, that's ticker SPY, it's up over 1/3%, hitting a new high. The Dow, even smaller companies, they're all in the green. So at first glance, it looks like a solid, healthy market. But this is exactly where the real story begins to get a whole lot more complicated.
Because while those US numbers are climbing, the wider global system is showing some really serious signs of stress. And that's the great disconnect we're digging into. How can one part of the system look so incredibly healthy while the rest of it is under such immense, undeniable pressure?
Well, the answer seems to lie in this powerful three-front headwind. And these aren't just small, isolated problems. No, these are three distinct, systemic forces all hitting the global order at the exact same time. We've got geopolitical conflicts boiling over, a global trade system that's fracturing, and the decay of institutions we've always relied on. So let's break them down, one by one.
Okay, our first headwind takes us straight to the Middle East. Tensions around Iran have just about reached a boiling point, and it's all because of these so-called snapback sanctions being triggered. And this isn't just a regional spat. It's tied to a growing alliance of nations that are really starting to challenge the current world order.
So what in the world are snapback sanctions? Well, think of it like this. It's a super powerful diplomatic trigger that was built right into the 2015 Iran nuclear deal. It gives the key signatories, in this case the UK, France, and Germany, the ability to single-handedly bring back all of the old UN sanctions if they think Iran isn't holding up its end of the bargain. And guess what? They just pulled that trigger.
And this didn't just come out of the blue. The escalation has been incredibly fast. Just back in June, we saw a direct 12-day war between Israel and Iran, which was followed by US airstrikes. Now, with that diplomatic trigger pulled, the full weight of UN sanctions is set to slam back into place in just 30 days. It's a really, really dangerous path we're on.
Now, ordinarily, news like this, war, sanctions, would send oil prices completely through the roof. But the market's reaction has been, well, tense but weirdly muted. Sure, prices are up, but they're nowhere near the panic levels we've seen in past crises. So the billion-dollar question is, why isn't the oil market freaking out?
Well, there are a few big reasons. For one, the market's been expecting these sanctions for a while. Plus, global oil demand is looking pretty weak, and other countries are pumping plenty of oil to make up for any shortfall. But the real game changer here, the big one, is that last point. China is now basically an importer of last resort for Iran. It's creating this whole parallel market that operates completely outside of Western influence. Okay, that's headwind number one. Let's move on to number two. A sudden, really aggressive new front in the global trade wars, and this time it's targeting one of the world's largest and fastest-growing economies.
The core of this shock just boils down to one staggering number: 50%. The US has just slapped a new tariff regime on India, pushing the total rate to 50% on over $60 billion worth of goods. I mean, that's a massive economic punch aimed right at a country that's supposed to be a strategic partner.
And this pain is specifically targeted at industries that employ a ton of people. For textiles and apparel, experts are warning that exports could just collapse by as much as 70%. For leather goods, entire product lines could become unviable, literally overnight. We're talking about the livelihoods of hundreds of thousands, if not millions of workers here.
The reaction in India's financial markets was immediate, and it was brutal. On Dalla Street, which is basically India's Wall Street, both of the major indexes, the Sensex and the Nifty 50, dropped about 2% of their value in just 2 days. Foreign investors just yanked billions out of the country.
But here's the fascinating counter-narrative. India is not just rolling over. The government is responding with a strategy they're calling strategic defiance. And you know why they can do this? Because unlike a lot of other countries, India has this massive internal shock absorber, its own gigantic domestic market. With consumer spending making up over 60% of its economy, it can actually weather this kind of external storm better than most.
That brings us to our third, and maybe the most foundational headwind of them all. This one isn't about a conflict thousands of miles away or a trade dispute. This is about the very bedrock of the entire global financial system, the independence of the U.S. Federal Reserve. And folks, that bedrock is showing some serious cracks.
What's happening is nothing short of an unprecedented constitutional battle. The White House has tried to fire a sitting Federal Reserve governor, Lisa Cook. Now, the official reason they gave is being widely dismissed as just a pretext. Most analysts believe the real goal is to create enough empty seats to install a 4-3 majority on the Fed's board, which would effectively let them seize control of monetary policy. And Governor Cook, she's now suing to block the whole thing.
And to really understand the gravity of this moment, just listen to this quote from a Fed historian. They're calling this a potential end of Fed independence as it has been constructed and reconstructed over 112 years. This is not some minor political squabble. This is a direct challenge to more than a century of institutional stability.
So, why does this matter so much? Why is Fed independence considered this untouchable bedrock assumption? Well, it all boils down to this fundamental conflict. An independent Fed's goal is long-term price stability, and it uses data to get there. A politicized Fed, on the other hand, its goal is short-term economic stimulus, and it uses politics to get there. That shift would turn a predictable, credible institution into an unpredictable, unstable one, and that would shatter a core assumption that global markets have relied on for decades. Okay, let's pull all of this together now. We've got these 3 massive global headwinds blowing: geopolitics, trade wars, institutional decay. And yet somehow, U.S. markets are just flying high. What this creates is a deeply, deeply unsustainable divide. It's like a battle between a really powerful story about the future and the very real, very heavy gravity of the present.
And this is what that fracture looks like in real time. You've got U.S. tech and AI stocks posting these strong gains, but at the same time, other parts of the U.S. market, like utilities, which are sensitive to interest rates, are getting absolutely hammered. And of course, markets that are directly in the path of these headwinds are seeing sharp losses. It just goes to show you how incredibly narrow and specific this U.S. rally really is.
So, what's the bottom line here? What are the key takeaways from all of this? First, the U.S. rally is fragile, it's narrow, and it's being driven almost entirely by one single narrative: AI. Second, the global risks we've talked about are not only real, they are getting worse. Third, even inside the U.S., fear around interest rates is hitting big parts of the market. And the big conclusion from all this? The market appears to be severely underpricing these massive global risks, at least for now.
Which leaves us with this final critical question. We are watching a standoff between 2 immense forces: the incredibly powerful, exciting story about future-changing technology like AI, and the undeniable heavy gravity of present-day global instability. The real question is, which one is ultimately going to win the tug of war for this market?